Hi guys, and welcome back to the Insurance Guru. My name is Ayanda Malele, and thank you so much for tuning in once again as I talk about my favorite subject, insurance. This is a quick video, trying to make it a quick video, about a question that I got on my YouTube channel where somebody said they had a major accident. The insurance company said the car is going to be a write-off, so they replaced his car with another car, and they then took the car back. But he thought he could still keep the old car, sell the parts, and make a little bit of extra money. And, sounds good and well and noble, but let's think about this. This is the introduction of something called salvage, and what salvage is and what it means for the insurer and the insured. Basically, when the insurance company says we are going to cover this very high value item for you, they are basically taking it and putting it in a pool of funds with other people who are also in the same vein trying to protect their big assets. What their main aim is to put you back in the same financial position as you were in prior to the loss. That is it. So if you had a car for 100,000 rands, if there is an accident, you must have something equivalent to 100,000 rands, whether it's by another car or by another 100,000 rands that you can use to go buy a vehicle type thing. But basically, that's the ultimate thing of it. What it's not meant to do, insurance, it's not meant to enrich you and then to say, oh, you can have a car plus an extra car. So the reason why the insurance company takes this other car is not because they want to make a major profit from your Kia Picanto or whatever the car is. Don't know what the guy was driving. But they are trying to say, okay, we've insured you from this pool of funds with other people that are also insured with us. So we want to ensure that next time somebody else has a claim, that there's enough money. So whatever they can salvage from the item that was damaged, that they've covered, given you your 100,000 rands, whatever they can salvage and sell off to at least maybe make 10,000, 30,000, whatever they could make for the salvage, to take it and put it back in this pool of funds so that another person, when they have an accident, they also enjoy the cover and the benefits. That's really the long and short of it. And to make another classic example, imagine somebody that buys a brand new, X5 this month, and they put it on cover, and the insurance premium comes to 2,500 rands. 2,500 rands, they pay this amount for the next 2 months. The X5, let's say, is retailing for 899,000 rands. But they only pay this 2.5 for 2 months. When they have an accident and they've been paying their claim, or they've been paying their premium, and the accident was valid, and they didn't do anything illegal, everything was on board, the claim was a valid claim, the insurance company is going to pay that 700 or 899,000 that car cost. They will pay that. But if it was a write-off, for instance, the rest of the car that now is written off, do you think it should really go to the guy that we've only gotten 2 months premium out of, as an insurance company? That would be enriching him, because now he'd score a new car and he'd score another one. No. The other one that he's got is like, now insurance company has already paid hundreds and thousands in a claim for somebody who's only paid for 2 months. But that also means that Ayanda and Sihle and Lucas have all been paying for the past 5 years, and they haven't had a claim, and now this guy just comes and rams into somebody or something like that happens. Now when he gets paid, we still need to make sure that our premiums, as me and the other 3 people or the other thousands of people that are in insurance companies, also enjoy cover should they have it. So when the insurer takes back the salvage, they really are doing it to put it back in the pool of funds. Guys, if you think about it logically, whatever your car is, even if it is an X5 or whatever it is, your insurer is not going to make a profit out of that car. That car is literally to make sure, Kuti, whatever they couldn't get, in premium to make the claim valid, it's also then to get it through the car, but not to get it so that they can be richer and pay themselves bonuses. It's to put it back in the pool, so when somebody else claims, there is enough within the pool. Because otherwise, if we did this thing of you get a car plus your damaged car, that's called enrichment, which is not covered. You're only covered for indemnity, which is putting you back in the same financial position as you were in prior to the loss. Just giving an example as well, I had a claim last year for a cell phone. My cell phone was damaged. They tried to fix it, but the back was loose. It was just weird stories. So the insurer decided they're going to give me a brand new phone. So I got a brand new phone, got to collect it and everything else. The cell phone that is still broken, it's still at my house. It's sitting there in a little box waiting, because they're going to call in the next 6 months or in the next month to say, hey, somebody's going to come through for that cell phone. That cell phone, I don't feel bad for giving it back to them, because I understand what they're doing. They need to try and reclaim or recoup the amount of what was lost to be able to put it back in the pool for other people to claim, because it would be technically unfair to the insurance company to cover you and then you claim for something big, but you still expect a little bit more back. Come on. So yes, basically it's not to cheat you out of the system. It's to ensure that other people that claim in future also do enjoy the benefits that you may have enjoyed as well. So I hope this did explain it to you well enough and that you understand it. If you've got any more questions, please feel free to also just ask me. Don't forget to also go into my YouTube channel, click like on all the videos that you see and you listen to, but more importantly, subscribe. Thank you so much. I'll see you in the next video. Bye.